to the Smart Property Investment Show with your host, Phil Tarrant.
G'day everyone, welcome to the Smart Property Investment Show. Thanks for tuning in. Phil Tarrant here. I am the editor of Smart Property Investment, joined today by one of my regular co-hosts, Jim Hall. How you going, mate?
I'm very well, thanks, Phil. Good to be back.
Thanks for being here. So Jimbo heads up mortgages and real estate here at Momentum Media. So underneath him sits a number of different titles and communities, one of which is property investment. So Jimbo steers the ship in terms of the whole of smart property investment from both a commercial and content angle, and I work closely with him on, I guess, really ensuring that what we talk about, what we write about on smartpropertyinvestment.com.au is exactly what you guys want. So there's a bit of a background about Jimbo, but what you need to know about Jim is that as well as his day job, he's also a property investor with a considerable property portfolio. So I've asked him to join us again just to lend some of his insights, his sentiments, and some of his experiences investing in property. So fair, good.
Very good, accurate description.
Oh, really? Yeah. It's good. So we're joined today. Our guest is Glenn Newbury. Glenn is a property investor, and I've asked him to come onto the show, and I don't really know a lot about him, and that's deliberate because I want to hear about his story just as you guys hear about it as well. So it's a deliberate strategy on my behalf, so we can actually have a real chat about his portfolio and how he's got to where he is today without any sort of pre-planning ideas about what we're going to chat about. So Glenn, mate, welcome to the show.
G'day, Phil. Thanks very much. Good to be here.
Are you a long-time listener, first-time speaker?
Yeah, I am indeed, yeah.
It's good. How about some critical feedback to start with? Do you like the show?
Yeah, I love the show. I love the real aspects of it. So especially when you get people like myself who are going to come in here and talk about their portfolios and how they invest, but also obviously some of the bits that you talk about, the brokers you get in here. You've had brokers in here and talking on that as well. So people get a real aspect of how to go about property investing. And I think that's a great part of it, yeah.
How do you use the show to sort of, I guess, influence how and why you do what you do? Investing?
I like to listen to other people's stories. I think that's a big thing for me is people want to hear real stories. They don't want to, just hear people saying, oh, yeah, you can do this and you can do that, but they want to hear how people really are going about doing it. So, and obviously the different things that people are doing, which is really good. So, that's the part that I like about it most.
That's good. No, I appreciate the feedback. What we try and do is, and I guess it comes to the spirit of smart property investment and why we do it, is to actually give just a real world take on how to invest in property. And, I'm a big advocate of property investment. I'm a big advocate also of showing that or trying to articulate that it's actually a pretty simple thing to do. You don't need to make a complicated property investment. Hopefully the show sort of demystifies a lot of some of the secrets and the skullduggery you sometimes hear in property investment, actually, get people on the right track and knowing how to go about doing it and try not to complicate it. So, Glenn, your story, mate. Let's start at the beginning. Well, let's start at your portfolio today. How many properties have you got?
I've got 10 titles, but 14 rentals, yeah.
Okay, 10 titles, but 14 rentals. Okay, so we can chat about that because instantly I think you've got a couple of properties on different blocks of land and stuff like that, but we'll go through that. So when did you start investing?
I bought my first investment property back in 1998, so I've been investing for 18 years.
18 years. And so you got 10 properties and sort of total valuation of your portfolio?
About 3.5 mil, I think, yeah.
Okay, 3.5 mil in 18 years. It's pretty good. And your total debt on your property at the moment?
About 2.2.
Okay, so you got about 1.3 million bucks in equity that you've created in that portfolio.
Yeah, that's right.
That's really good. Interesting. And sort of cash flow wise, positive, negative, neutral?
It's positive by about $250 a week.
$250 a week.
Yep.
So it's $250 in your back pocket every week because you have this property portfolio.
Correct.
And what do you do with that money? Is it just chuck it into your coffers and you use it and buy coffees and just normal household expenses, or are you sticking that somewhere as a way to save for a new property?
Yeah, that's right. Yeah, it's sitting in offset and it's gradually growing, obviously, every week, combined with my own savings to go towards purchasing additional properties, yeah.
You're an active investor, so when was the last time you bought a property?
I haven't bought anything for about just on 2 years now because I used to work in IT and I got made redundant in my job and I was out of work for 7 months, and then I came on board with Right Property Group and I contract to those guys. So I can't borrow at the moment because I'm self-employed effectively. So you've got to show income history and all that sort of thing.
That's cool. So, and that's interesting, the financing part of it. So you've gone through a bit of an evolution. So you bought in 1998. So you've been at this for 18 years or so, and you had a full-time job then? You
Yeah,
get
that's
show
right.
PAYG.
So, yeah, but I was doing different kinds of investing. Back then, I was trading. So I would buy something, I'd hold it, I'd sell it, I'd buy it, renovate it, sell it, buy it, develop it, sell it, and bought and sold properties overseas as well. But then I met Right Property Group, the guys from Right Property Group in 2010, and that's when I really started to invest. So I actually wasn't holding anything at that point in time. But then when I met Right Property Group, realised that the strategy I was doing really wasn't going to get me to provide an income, and that's when I started holding property. So that was back in, I started buying from Right Property Group or using their services in 2011, and that's when I built that portfolio. So that's been created, it was created in 3 years, because I haven't bought anything since 2014.
Okay, that's good. So that's an evolution in you as an investor and probably your sophistication as an investor. And what you've done is, I hear a lot of people have done that, buy, sell, blah, 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 blah. It gets quite sort of heavy, but now you sort of changed tact and strategy because of the influence that your buyer's agent has had on you. And from what I understand now is that you started using the Right Property Group as a buyer's agent, but now you're actually working within the business because you like what they do so much.
That's right, yeah. So I just started using them as a client and built my portfolio using their services, and then was fortunate enough to be able to go and join them.
Get a job
as part
doing
of the business.
stuff.
That's
right.
right.
Good. No, they're a good outfit. Buy, selling, trading property. Jimbo, you've never done that, have you? You're a buy and hold man.
I am buy and hold, yes.
Yeah.
No, it's interesting. Interesting to hear that you've gone from, I guess, essentially flipping properties.
Yep.
When you first bought your first investment property in 1998, did you say, Glenn?
Yep, that's right.
So how long did you keep that for before you sold it, and what money did you make on that, if you don't mind me asking?
Yeah, I actually did pretty well out of that. I mean, it was a one-bedroom unit in Canterbury, and right across the road from Canterbury Station here in Sydney. And I think I paid about 112, borrowed 110% back in those days, cross-collateralising it with my home. But I had some trouble holding that property because when my wife left work to have kids, I was paying my mortgage, plus that one wasn't, the rents, the yields weren't that great back then. And so I sort of struggled a bit, and then when she left to have our second child, that's when I really noticed it and struggled with it and realised, I'm not doing this right, there's got to be a better way, and started educating myself. So that's when I sort of, after a bit of education, decided to sell that property, which was back in 2003, and it had pretty much almost doubled in value. So I held it for about 5 years, paid 112 and sold it for 220, I think, back then.
So what was the pressure points or the friction or the light bulb moment that you had that said, this trading property is hard work, I don't really know where I'm going with it, or it's quite intensive and there's a lot of stress probably associated with it, versus a buy and hold strategy? When did you go, I'm changing what I'm doing?
That was after I met the guys from Right Property Group and started attending the seminars that they hold on a monthly basis. And when I saw how the way that they went about investing and what the goal was to actually provide an income at the end of the day, as opposed to what I was doing, which was trading, which means when you stop trading, the income stops. Obviously, we don't want that because we don't want to have to keep working to, it's just another form of a job by trading. By changing strategies and doing a buy and hold and building a portfolio that's going to generate an income, that you can sort of live off over time. That was the thing for me, and I looked at that and I went, yeah, I see that and I get it. So that's when I switched.
So you got 10 properties in the portfolio now?
Yeah.
Talk me through the makeup of that portfolio. Where are the properties? What are the properties?
So at the time I was buying, obviously timing the market is very crucial. And back then when I started purchasing using Right Property Group back in 2011, New South Wales was the market because there was great yields here and you could buy properties relatively cheap and get like a 7% yield without too much drama in the metropolitan area. So my properties, there are a lot of them in New South Wales, but I also have a couple of regional properties too, which were purchased to boost my cash flow. So I've got a couple of properties in regional New South Wales.
Whereabouts are they?
So I've got one in Dubbo, which is a house in Dubbo, but I've also got a block of 4 units in Moree. So and they're cash flow properties, which are predominantly there just to boost my cash flow, to allow me to have a bit of negative cash flow within the other properties in the portfolio. Where
are the properties in Sydney? Are they Western Belt?
Yeah, that's right. They're in the affordable areas, so the Campbelltown areas and that sort of area from Blacktown out to sort of Penrith.
That's good.
Penrith way, yeah.
So we chat about this a fair bit on the show, Jim, sort of pairing properties, really. So obviously you invest in property because you want the thing to go up in value, but you want to hold the property as cost effective as possible. So you want the property to go up, and you also want the yield to hopefully cover the mortgages, right? But sometimes you find really good capital growth properties, which might not have a very good yield. Then alternatively, you might find really good cash flow properties that might not show the same growth potentials. And you've got some of these in your portfolio as well, haven't you?
Yeah, it sounds like quite a similar portfolio to myself. Sometimes you're fortunate enough to find something that's high in capital growth and also pretty good on the yield as well. But that's certainly becoming less and less harder to find, or more and more harder to find, rather. I think, my portfolio is, I put in a bit each month, but I guess when the time comes, I claim my tax back, and they're pretty sort of neutral across the board. Some cost me a bit more than others. I have a couple of minor repairs from time to time, which adds to the costs. But more often than not, by the end of the year, it comes back as pretty neutral, my portfolio.
So when it's probably a question for you as well, Glenn, is who helps you understand the fluidity of cash moving around your portfolio, and when and how you might need to be looking for a higher yielding property to help offset, some of those properties that aren't yielding so well, so you can try and get to a neutral position. Is that conversations, Glenn, that you have with your accountant? Is that where that comes from?
Yeah, I guess, and trying to keep pretty good records. I'm pretty diligent with my portfolio, and I've got spreadsheets that tell me everything about everything. And obviously speaking with your accountant, and then again with your property strategist, which in my case was my buyer's agent, which was right. Probably.
That's good. And you're the same, or you generally take your lead from your accountant, don't you?
Yeah, I spend a lot of time with my accountant. I catch up with my accountant on a regular basis. He's someone that invests in property as well, so he understands the needs of a property investor. But I'm the same as Glenn. I've got a number of spreadsheets that I look at closely, perhaps not quite as close as I should sometimes. I often find myself spending a few late nights at work updating them, where I've forgotten to go through them for a couple of months. But they're a good indicator of where you're at. You can see if you've got everything written down in terms of your income and your costs. If you're using a property manager to service your property, each month they're going to send you a statement, and that shows you exactly what's coming in and exactly what's going out. And I use my property managers to do everything. They take all the bills in, they pay all the bills. So for me, someone that's pretty forgetful, it's a good way of managing things, and just got to look at that statement each month, write it down, and you can see exactly where you are.
That's good. So Glenn, you switched from a trading type strategy to a buy and hold strategy, where you've been buying. So everything's in New South Wales, all your properties?
No, I've got one in Queensland.
One up in Queensland. Whereabouts in Queensland?
It's in Woodridge in the Loganshire.
Okay, I've got a place in Woodridge. Yeah, it's good place. Cool. You've done well out of it.
Yeah, it has gone pretty well.
Yeah, it's good. I think I've got like a 2-bedder townhouse somewhere on North Road.
2-bedder townhouse. Yeah. Mine's on Smith Street.
Okay, yeah, just around the corner. Yeah. Lots happening up there, and we talk about it a lot in the show, that sort of area of Queensland. So if you pick around, and you'll find some stuff there if you want to. So changing strategy, good. Yeah. And some of that has been influenced by your sophistication as an investor, and you've gone through a process of educating yourself, and you've developed your strategy as a result of that, which is right. Good. Yep. What would you say were the main resources you used to better equip yourself to be a better investor in terms of that education type thing? Obviously, you started working with your getting involved in buyer's agent seminars, and they do a lot of stuff, I know, around just helping educate people. What else did you do other than that?
Yeah, I've read books, obviously, and lots of different kinds of books regarding investing and I guess wealth creation. And going along to property investment seminars and the expos and doing different courses and things like that. So I've spent quite a bit of time and money educating myself in property investing over the years.
And the outcome of that is that you've got a different strategy now. That's the buy and hold. I imagine you want to buy more in the future. But so what's your goals? What's the end game for you?
The end game for me is obviously to have a portfolio that's going to generate the income that I want, and the portfolio to be debt-free and providing an income. So for me, my goal is hopefully to have that, once I can start borrowing again. I'm actually in the consolidation phase because I've actually built the portfolio that I want, and it's generating the income that I want. All I have to do is get rid of the debt. So I'm certainly hoping that when I can start buying, I'll start consolidating that debt. and buying properties to help me assist me to do that. And then once the debt's gone, I'll be in the Bahamas somewhere.
So what mechanisms do you have to get rid of the debt? You can either pay off the principal component of the loan, and where do you get the money to do that? You either use savings or you sell some properties down.
Initially, I'll be acquiring additional properties, which will be properties that I can potentially add value to, and then adding value to them, and then selling them down at some point in time and using the profit from those to pay down the debt on the base portfolio, which is what I call it, the base portfolio. Yeah.
And you've got a number of how many properties you want to have debt-free to provide for a comfortable retirement? You have that number?
Well, it's not necessarily a number of properties. It's more about the income that those properties provide.
Correct.
So I want to be earning a certain dollar income per year from my portfolio. So the portfolio I've built is providing that income now. At the moment, though, there is debt against it. So a lot of that money is going to the banks. But in the future, when I'm able to pay that debt off, that income will be coming to me and not to the bank. So
Glenn, have you actually got it? Because it's something we talk about a lot on the show, is building a portfolio up to a certain stage, and everyone has a slightly different goal in terms of how much they would need to, to be, I guess, self-funded. In terms of that, I guess, that final stage of selling down the portfolio or selling down the debt as such, in your position at Right Property Group, is that something that you have a blueprint, you know exactly what you're going to do, i.e. I'm going to take on this amount, I'm going to buy these properties, add some value here. Do you have a strategy to I guess, get out of the debt?
Yeah, for me it is going to be, like, I'm a pretty active sort of person as well, like as far as being active within the investing, and I'm reasonably hands-on when I can be, so I don't mind getting the hands dirty and doing a bit of a renovation, because I've done a number of those in my portfolio, and prior to when I was doing the flipping, I was renovating during that phase as well. So yeah, for me it's going to be about finding those properties that are going to add value to, and then, in consultation with my accountant, determine the best time to sell it and then take the profit to use to pay down debt. And then just depending on where the portfolio's at as to which sort of property I'm going to need to add to it at that point in time, yeah.
You've gone through an evolution with your strategy. If you go back to Glenn back in 1998 and said, mate, look...
Had no idea what he was doing and just bought a property because I was a really bad saver. I was hopeless at saving money. So it was a way of forced savings for me. That's really why I got into investing. You
can go grab yourself there and say, hey, look, I'm Glenn from the future. I've travelled back in time to make sure you don't be an idiot. What would you say to yourself? And not that saying you have been an idiot. You've done well, but like, imagine you made some big mistakes. What would you say?
Obviously not getting the education before I started, because you're not that I've bought a lot of bad properties, but I could have been buying better. And if I'd had the knowledge, and then, learning how to use money, making money work for you is really important in doing what we do, making it work hard for you. And I know people say that and they don't really understand how that works, but there are ways that you can, especially leveraging. If you can leverage and you get it right, it's extremely powerful. And you can, when I teach people about property investing or speak to them, I talk to them about leveraging and the power of it. And I do an example where you can start out with $100,000, and in 10 years' time, depending on how you leverage, you can end up with 2 properties, 6 properties, or 9 with the same $100,000. And it's just how you leverage that allows you to do that. So it's a massive difference.
And that comes down to risk appetite, obviously.
Absolutely, yeah.
Circumstances, etc.
Yeah, of course. And it's not for everybody that way, and you've got to be careful where you use leverage as well. You don't want to be buying a property and getting into negative equity if the market's shifting the wrong way and you're highly leveraged. So you've got to be careful with that, obviously.
Yeah. So outside of educating yourself more effectively earlier on, like what's the biggest blunder you've made? Is there anything in particular where you've just, why'd I do that?
I was doing developing for a little while as well, and that's it's really high risk, really. It's great returns.
So by developing, buying something, building something.
Yeah, knocking down, building. It's great. It's very rewarding, and they're great profits to be made, provided everything goes the right way. But there are so many things that can go wrong in developing, and they say the money's in the ground, and that's where it is. You spend most of the money getting the development up out of the ground, and then once everything's above the ground, it's pretty straightforward. But there's so many things under the ground that can cause you grief, and
absolutely,
yeah. And I was fortunate that it didn't go that way, but it certainly taught me that it could easily go wrong, and there goes your profit.
Yeah. Your current portfolio, what's the best property you currently have? And best, that's up to you what best is. But,
I talk about probably my Mount Druitt property, but what I've learned, it is all about the numbers. Investing in property is a financial decision, not an emotional one. And the reasons that I wouldn't have bought in Mount Druitt were all emotional reasons, not financial ones. And certainly that's probably been one of my best properties. It's almost doubled in value in 4 years. It's got a great yield. The tenants are actually fantastic. They're probably one of the best tenants I have out of all of my properties. They never miss a beat. They're always in advance with their rent. So I love that property, and it's in a great location for anyone that wants to live in Mount Druitt. It's right across the road from the shopping centre and the train station, and the schools and the...
Mount Druitt is, it's the heart of the western suburbs. It's in between Blacktown and Penrith. The demand for property in those areas is high. It's a growing population. The demands for property in Sydney is just rising and rising and rising. And Mount Druitt is an affordable area, and it's got a high rental base. So
Absolutely.
hence the reason why. And everything's there. You can jump on a train, and one train you're in the city.
Correct.
It's got sporting facilities, great hospitals, great shops, great everything. It's there's a number of reasons why people live out there. There's a number of reasons why, and there's probably reasons why you should be investing out there.
Yeah,
but
absolutely.
Go and explore. What's the worst property in your portfolio?
Worst as far as performing is probably Dubbo property, purely because when regional properties go vacant, they go vacant longer. I had a bit of an issue with that, where it sort of had a bit of an incident with a matchstick, and so there was a few issues around that, which, provided you got the right insurances and everything in place, it takes care of it, but it's just a bit of a headache when it's all going on. And I've had a lot of vacancy in that area, and there's obviously a bit of an undesirable element there, which causes a bit of grief sometimes. So it's probably been my worst performing property as far as that goes. But it still does when it's rented and tenanted out.
All right.
It's really good. It's like a 10% yield. But like I said, when it goes vacant, it's vacant for longer, and trying to get the right tenants in there is a challenge, and that's a property manager's job.
Yeah, it is. So, massive hypothetical. I'm going to give you $50,000 to invest in property today, and that $50,000 needs to be deposit, stamp duty, legals, etc., conveyancing or whatever. Where are you going to buy?
Without question, in Queensland at the moment, in that sort of affordable corridor there as well. It's got exactly the same characteristics as where I was buying, say, for example, Mount Druitt. So in the Mount Druitts of Brisbane.
So you're talking sort of Logan area, a little bit further afield. Yeah.
That $50,000 is going to work hardest for me, because that market at the moment is growing in value. It's going to be working hard for you as far as building up equity, and cash flow there is still pretty good. So that's my pick.
I'd probably do exactly the same with my $50,000 as well.
Wouldn't go straight to the casino?
Tried that.
Double it by 2 properties?
$5 maybe.
$5. Yeah. Risk management is what it's all about. That's really good, Glenn. Thanks for the insights, mate. If I was going to take a few things out of this chat, I'll sort of scribble down 4 things. One's about pairing property, understanding the different dynamics of a property that's going to have good capital growth dynamics and properties that are going to have good yielding dynamics, and the fact that sometimes to hold a property that's going to grow in value higher above the average, it might cost you a little bit more to hold it. So you need to find the cash somewhere to balance that out. So
that's right.
For you, it's very much around a regional property that gives you a 10% yielding property when it's rented versus one that's going to get capital growth maybe out in Mount Druitt or somewhere else in Western Sydney where the yields aren't going to be so high. So that's one point I'd make. Number 2 would be around cash flow. So understanding that cash flow, speaking to your accountant, knowing how money flows in and out of your portfolio, where you might be up, where you might be down, and where you might be looking for tweaking a few things. End goal, you're obviously someone who is set on a particular process to provide for a comfortable retirement, wealth creation. So how much value, so it's not the number of properties, but it's the value of the properties that you have unencumbered with debt that's going to give you a salary. It's going to give you money moving forward. It's the rental
income as opposed to the value of the properties. You need to live on cash flow. You can't live on equity So it's not to do with how much the properties are valued at. It's to do with the income that those properties provide. And that's what I've got. I've got a income figure that I want to be earning, and I've built a property portfolio accordingly that generates that income.
On that basis, then, you want the higher yielding properties are the better ones, because when they're completely paid off, they're the ones that are going to be giving you proportionally a higher income, which is good. But anyway, it's all a balancing act. It's all about property selection, how that might change over the process of building a portfolio. So whether you're in sort of accumulation phase or consolidation phase, I started investing in property when I was about 35 or so. So in many cases late to the game, but in many cases quite early to the game.
Yeah.
So I've probably got a good 30 years of working life to invest in property. So I'm going to make hay, as are you, Jimbo, aren't you?
Yeah. Indeed,
Yeah.
Yeah, I wish I was doing this strategy that I'm doing now when I was 35. Unfortunately, it was a bit later than that for me.
Yeah. But there's no excuse now not to be educated around property. You obviously got some exceptionally good podcasts, Jim, like the Smart Property Investment Show. But, there's no excuse. There's information everywhere. Go to YouTube,
absolutely.
websites, magazines, seminars. There is no excuse not to be investing in property, to be able to research and understand property and educated in property. So my recommendation is go out there and fill your brain full of knowledge, but make sure it's the right knowledge. Be quite discerning when you look at property investment seminars. A lot of people give away a lot of good free information, but you need to make sure it's not pegged to some crazy get-rich-quick scheme sort of towards the back end of it. So be smart, have your bullshit meter out. That's what I do, and you should do all right. So Glenn, mate, thanks for coming in.
No problems. Thanks very much for having me.
Good to see you here, mate. Jim, thanks again, mate.
Thanks, Phil. No problem.
Good to have you on board. Remember to check out smartpropertyinvestment.com.au. You can email me, editor@smartpropertyinvestment.com.au, if you have any questions. If you'd like any further information or any feedback on the show, you can follow me personally at Philip Tarrant on Twitter. And look forward to you guys tuning in next week. I'll see you then. Bye.